2021 has been a real roller coaster ride, with major events that have fundamentally changed the world of finance. In this video, we give you the 5 biggest trends that took investors, analysts, and businesses by surprise in 2021. COVID-19 took a huge toll on supply chain management, shocking even analysts who were already skeptical of supply chain composition pre-COVID. The extensive short supply of physical products, including PPE kits and durable goods, gave rise to supply-driven inflation. According to Drury, a supply chain consultancy, the shipping of a 40-foot container across a range of routes cost, on average, 4 times higher in 2021 than in 2020. There was severe workflow disruption at ports in China and other Southeast Asian countries due to COVID countermeasures. However, the major contributor was high demand for physical products in America, where the expense on durable goods rose 34% since early 2020. Comparatively, there was only 4% increase in the demand for services. As the severity of COVID has depleted to some degree, the gap between goods and services must soon narrow. But still, the supply chain may be compressed as compared to pre-COVID norms. For a good part of the decade, investors competed to get access to Chinese assets, thanks to an intriguing tech sector that showed booming results every now and then. However, to investors' surprise, the regulatory crackdown of 2021 has dropped MSCI China Tech 100 Index by a third since the beginning of the year. During the same period, the Chinese e-commerce giant Alibaba saw a 50% fall in its stock price. The Chinese real estate market was also in turmoil this year, to say the very least. The prestigious symbol of the Chinese real estate sector, Evergrande, has been defaulted due to the government's efforts to restrain developers from borrowing. The future of the tech and real estate sector is under biddable conditions, only at the mercy of the Chinese government. It seems like the investment performance in China is intertwined with the mood of the administration. After 2020, analysts as well as investors did predict a sharp revival of earnings in 2021. What they did not anticipate was an overwhelming rebound that exceeded all projections. The consensus was an expected 22% increase in earnings per share on America's benchmark stock index, S&P 500. But the growth, even without adding in fourth quarter earnings, stood at 45%, more than double the expectation. Take a look at this against 2010, when after the global financial crisis, the total earnings growth of the year had risen to 40%. This shows how fast the economic recovery was, in contrast to what was expected, exceeding not only 2020 levels, but also that of 2019 as well. Now, though this seems like great news all around, it actually puts the stock markets in a tough position. The predictions for economic recovery that was supposed to happen in 2022 have already happened in 2021. Though analysts are predicting another 9 to 10% growth in 2022, the inexplicable growth we already had might be undermining any further predictions. Along with several public services, banks were also concerned about the difficulties of operating amidst a pandemic in 2020. Most of their concerns were about how they were refrained from having the usual number of client meetings, sales pitches, or roadshows for IPOs. Not to mention the uncertainties of how the economic outlook unfolds in coming years. To everyone's surprise, the first 11 months in 2021 saw $148 billion raised through listings in America alone. Not only is this a high number, but it is twice the amount that was raised in 2020 during the same period. Though the high roll was marked at the beginning of 2021, there hasn't been any drop in the boom as the year draws to a close. This surge did give rise to doubts that private capital may supersede public markets, but the flotations suggest otherwise. It was observed that the banks are losing power over listings, as companies that plan to go public have the option of either going for direct listings or merging with special purpose acquisition companies, or SPACs. In the fourth quarter of 2021, a total of 621 companies have gone public around the world, including SPAC mergers. Compared to 2020, this is a 16% increase. Quite often, investors and executives have been mocked for being part of environment-friendly projects, as green finance was seen as a mere outlier. Well, this was the case until 2021. Around 20 countries issued green government bonds that have an absolute positive impact on the environment. The EU issued its green bond for the first time in mid-October, selling at around $13.6 billion to passionate investors. Green finance has seen splendid growth in the private sector as well. In the first half of 2021 alone, there was $60 billion worth of investments made in startups related to climate tech. This is 3 times higher than for the same period last year. Electric vehicle manufacturers like Tesla and battery manufacturers like CATL saw a huge growth in investments in 2021. What more, in the month of May, ExxonMobil lost a proxy battle and voted more climate-friendly directors to the board. In the same vein, a large number of oil companies are taking measures to implement hydrogen technologies. Though green finance has a long way to go before a proper carbon pricing system is in place, developments and projections so far show a promising future for this sector. The ups and downs of the finance ecosystem is nothing new. If anything, volatility is a defining characteristic of it. Nevertheless, it is important to watch out for surprises, good or bad, if we are to make the most of the leaps and stay secure during the dips. We hope this video has been of some help to you in that regard. If you liked the video, hit like and subscribe to the MyMoneyKarma channel to get your daily dose of insights from the wide world of finance. Over and out.